Well, can you all hear me up the back? Welcome. Nice to see some familiar faces after 3 years. So, welcome everybody. Rob Millner is my name. I'm Chairman of Pattinson, and I think we've got, and on the with me, I think we've got. Here we go. Todd Barlow. Todd's been with us since 2004. He first started with our investment bank, Pitt Capital Partners. Then we expanded Pitt Capital Partners over the years. We had an office in Adelaide and an office in Hong Kong, and Todd went up and ran that for 3 years. And he's been Managing Director of Pattinson since 2015. And the one next to Todd is David Gribben. David is our CFO. David started with us in April 2018. And before that, he was with the Trust Company, which a lot of you people will remember. And then at the end is Brendan O'Day. Milton shareholders will remember Brendan. Brendan was the MD at Milton, and he came over to us, obviously, when we did the merger. And Brendan's previous experience before that, he was with Citigroup, and obviously had stints here, stints in Hong Kong, stints in Japan, and also in the US. And we've just got a new employee standing over there, Courtney Howe. She's our head of corporate affairs. She's been with us for 2 days, so don't ask her any hard questions. And also in the front here, we've got one of our directors, Tom Millner, our company secretary, Ida Lawrence, and one of our employees from Pitt Capital Partners, David Scammell. I don't think there's any other employees here. It's hard to see up the back. There's no other employees? Okay. This is the first for Pattinson. Milton have obviously done these over the years. We're going to Adelaide tomorrow, and then we're going to Melbourne next week. So it's going to be a good opportunity to get around and see some of you shareholders, as I said, particularly as we haven't seen a lot of you for 3 years. How many of you would be in favour if we had a DRP? You put your hands up. So someone try and count those, or? Huh? All right. Now this is a more important one. What about if we keep paying special dividends? I thought that'd be the same. What about if we had a rights issue? Yeah, I thought the same. All right, on that note, you don't want to hear from me. I'll now hand over to Todd.
Thank you, Rob, and thanks everybody for coming. We've got a short presentation to get through today. We want to maximise the opportunity to have some Q&A and then also leave some time at the end to meet with as many of you as possible over some tea and coffee. But I thought I'd just start by talking about the evolution of the company. I think many people would be aware of the deep history that Pattinson has, founded in 1872 as a Pitt Street pharmacy, eventually listed on the ASX in 1903. It's the second oldest listed company on the ASX. But the thing that we're most proud of is the discipline that we've had over that period of time as an investor and a steward of capital, and the fact that in all of that time the company's never failed to pay a dividend. Now that's through the Great Depression, 2 world wars, the GFC, coronavirus. It's something that is very important to us. So today we're a diversified investment company. We've obviously diversified away from being a pharmacy business sort of post-World War II, and that's continued right through to the last 12 months where we've merged with Milton and become even more diversified than we were. Today it's an ASX 100 company with a market cap of about $10 billion. That makes it about the 44th largest company on the exchange. Rob Millner, who you just heard from, is the 4th generation chairman of the company, and that's a really important connection that we have to the long-term investment discipline that the family has presided over for such a long time, and to be a steward of shareholder wealth. And we have today 60,000 shareholders on our register, which is quite an honour that so many people have chosen to invest with us and place their trust in us to look after their wealth. So what we have today is a unique investment strategy in the Australian market. Through WHSP, an investor has the opportunity to gain exposure to a range of asset classes across sectors, including private equity, private credit and property. Investment strategies that have delivered above market returns for several decades, steady and growing dividends, and a management team with a strong track record of execution and active stewardship of capital. Looking at the highlights of the last 12 months to 31 July, which is our year end, I want to emphasise that we focus on three things, and that is portfolio outperformance, increased cash generation, which enables us to pay increasing dividends over time, but also importantly, managing risk. And if I look at the portfolio outperformance, we had an excellent year. It was 20.2% above the index. So we did about 13.6% portfolio returns, but the market was actually down over 6.5%. So 20.2%, that's on a pre-tax basis. The other measure that we look at is post-tax, because the embedded tax liabilities in a portfolio are important, because if they are very, very high, it makes it quite difficult for the company to flexibly invest the portfolio. And so what you'll see with a lot of LICs, as an example, is if they have long-held positions with low tax cost bases, it makes it very difficult for them to trade, because obviously every time they sell one of those positions, they pay quite a significant tax. So what we achieved through the year was a big uplift in our post-tax asset value, and that was due to a number of advantaged tax outcomes that we got through the Millner merger. Looking at cash generation, the net cash flow from our investment portfolio increased 28% on the prior year. That obviously enables us to, that's the cash that we use to pay dividends to shareholders, and so what we saw through the last 12 months was 72 cents per share fully franked, which was a 16.1% increase on the prior year, which is extremely satisfying. In addition to that, we were able to pay a special dividend, or declared a special dividend of 15 cents, and that was due to the remarkable cash flows that we're realising out of our investment in New Hope. But then looking at the way that we managed risk through the last 12 months, we successfully integrated Milton, and not only did we integrate the Milton team successfully into the broader team, and that's been a very successful outcome, but we also integrated the portfolio of Milton. So there was quite a lot of activity to make sure that the Milton portfolio fits within our broader portfolio and also fits within our broader strategy. So what Brendan will talk about later is there was a lot of activity to sell down some positions, get a little bit more concentrated. We don't need to hug the index, and we can. We also look to cash up, because we could see some turmoil ahead in the market. So what we did in last calendar year was increased our allocation to cash. We also increased diversification through the year, and a lot of that came from the Milton merger. So if you went back to the start of calendar year 21, our major strategic investments were about 3/4 of the portfolio. Today they're about half of the portfolio, and we have a greater allocation to asset classes that are not straight Australian equities. So increased allocation to private equity, credit in particular, and also the investments in property have grown as well. We also managed through the volatile markets, and that's not just the equity markets. We saw in the last 12 months unprecedented levels of change to the macro environment. It's not that long ago that people were not foreseeing the amount of inflation that we're experiencing today. We went through a period where interest rates were almost zero, and people didn't foresee that they would rise so quickly as they have. And that necessitated us to react to that. And so what we saw in the last 12 months was about $7 billion of transaction activity in our portfolio. 3.5 of that was the acquisition of Milton, but there was another $3.5 billion of repositioning, both acquisitions and disposals, so that we make sure that our portfolio is fit for purpose and fit for the environment that we're in. And as I mentioned, we also took the opportunity to increase our liquidity, which is increasing our levels of cash, because we think that this market is perfect for us to take advantage of new opportunities, especially as volatility continues and alternate avenues of capital for companies that need it start to dry up. So we're seeing the IPO market, as an example, is now pretty much closed. So we think that we'll be in a good position. Now, moving on to dividends, this is a fantastic slide. As I said, we're very proud of the fact that we can increase dividends year on year. Not only did we increase significantly last year, we've had 20 years of increases, and the average compound annual growth rate has been 8.5% for the last 20 years. That's something that we would very much like to continue. We manage the portfolio accordingly. We want to ensure that we can keep that story alive. As I mentioned, we also have a special dividend which is not captured on that graph. Then looking at total shareholder returns, we aim to outperform the market in the long term. So we tend to focus on the longer term, but obviously the first thing that you'll see in that table is the last year. We actually underperformed the index by a significant margin. I'll come back to that in a couple of slides' time. But if you look at the sort of 15 and 20-year number, the relative performance has been significantly above index. And it might only, if you look at the 20-year number as an example, 3.4% per annum might not sound like a lot, but when you compound that, it has a very significant outcome. So over 20 years, an investment in SOL has gone up nearly 9 times, whereas an investment in the index is less than half that return. And put another way, I came across some data from Vanguard talking about the performance over the last 30 years of different asset classes. So I thought I would compare different investments in different asset classes to an investment in SOL. And if you look at Australian bonds, if an investor had invested $10,000 on the 1st of July 1992, that would have grown at 5.9% per annum, and today would be worth about $55,500. If that same $10,000 had been invested in the Australian listed property assets, so the real estate investment trusts, that's grown at 7.6% per annum. That's worth about $90,000 today. If you put that 10,000 into international shares, which is the global index, leaving out Australia, 7.8% per annum return for 30 years would have increased the value of 10,000 to 94,000. Australian shares have performed better than international shares, so over 30 years, that's a 9% total return. That makes 10,000 worth 131,000. But if that $10,000 had been put into SOL shares in 1992, today it would be worth 281,000. So you can see just a little bit of outperformance over a long period of time compounds to quite a significant gap. But one thing that we're conscious of is generating that outcome and that outperformance without taking on unnecessary levels of risk. And so this graph is really there to demonstrate that we actually perform better when the market is negative. So we protect our downside better than the market. And if we look at the last 20 years, about a third of the months, the index has been negative. And the average performance of the index in those down months has been 3.5% negative. But in each of those months, the performance of SOLs has only been 1.6% negative. So we're almost 2% better per month when the index is negative. So we are very much positioned our portfolio to be defensive and to protect capital. And I think that's probably the biggest source of our long-term outperformance. So I mentioned the last 12 months' performance, and the share price has gone down 21.3%. You can see there on that brown line. But that's despite the fact that the pre-tax net asset value per share has gone up 13.8%. So if you look at the relative performance, the share price actually underperformed the value of the portfolio by 35%. And you can see the All Ords there was down 6.4%. So, despite the fact that we outperformed the index by over 20%, the shares actually went backwards. So that divergence of the share price versus the asset value meant that by the end of 31 July, the share price actually represented nearly a 7% discount to the net asset values per share. There's a couple of reasons for the share price decline. One was the high starting point, so there was a lot of noise in the share price around the time of the merger with Milton, and that elevated our share price. So there's definitely some reason why it should have retreated from those elevated levels. But our view is it's overshot the mark, and we're now trading at a discount. And as we've always said, if you look at the performance of the last 12 months on any measure, the business is in a much stronger position than it was 12 months ago. And a lot of our shareholders now, as I said, there's 60,000 shareholders. Approximately half of those came across from Milton, and we recognise that those Milton shareholders were LIC investors and comfortable as an LIC investor. And I suppose you ask the question, what is it that's different about Soul Pattinson versus an LIC? And so we've got a few points here, and our argument is that it's a much better investment product than an LIC because we provide greater diversification and flexibility. So there's a lot of constraints on LICs about the way that they can invest. We can be a lot more active about the way that we invest and manage risk. We have a higher conviction portfolio, so we tend not to follow the index. We invest the way that we think is best for the macro environment, but also we take concentrated bets on businesses that we think have a long-term bright future. As I mentioned, we have a history of protecting capital, so we don't have the same sort of volatility that equity markets have. If you have an investment in an LIC that's 100% exposed to the Australian equities market, it's going to largely follow the rise and fall of the Australian equity market, whereas our diversification and the way that we manage the portfolio is protects the downside a little bit more. And we've done that in a way that's enabled us to achieve strong long-term outperformance. So I talked about the much longer periods of sort of 15 and 20 years outperformance against the market, but this graph here is a little complicated, but essentially what it does is it plots WHSP against 7 large LICs, so LICs above $1 billion, and looks at their relative performance against the market and also their either premium or discount to their NTA. So if we look at the WHSP's out there to the right, that means that it's had a superior investment performance to any of the other LICs. So over the last 5 years, our portfolio has increased by 68% total return. The market's done 50%, and 5 of the 7 LICs have actually underperformed the market. So they're to the left of the line there. And then if I look at the north-south performance, which is shows whether the LICs are trading at a premium or a discount, you can see that there's quite a few, or at least 4 of the 7 are trading at significant premiums to their NTA, whereas WHSP is trading at one of the bigger discounts. So we think that through WHSP right now, you're getting better performance and at a cheaper price. With that, I'll hand over to Dave to take us through the accounts.
Thanks, Todd. Well, last week we released the 22 annual report, all 188 pages of it. And while there's lots of useful information in there, it pains me as a chartered accountant for over 30 years, accounting standards introduce a lot of clutter. So I just want to spend just a couple of moments going through what the board and the management team focus on to drive sustainable and continual performance improvement. So on this side, you can see down left-hand side of the traditional metrics that you see in any statutory financial report. Focus on net profit after tax, earnings per share growth, and the balance sheet. But for us, all those things are in the annual report. But we don't focus entirely on profit to measure the performance of our investments. We look to see how we can improve the cash we receive on these investments, and that's what we call our net cash flow from operations. This is made up of the regular ongoing dividends we get from our investments, any interest income we get from our investments, trading income, less our corporate costs, less the interest and less any of the tax paid. So it's in this cash flow that we get from our investments we can use to fund that consistent and sustainable increase in the dividends that we pay to you, our shareholders. Instead of earnings per share growth, we focus on that growth in net cash flow from investments per share. And as Todd mentioned in the earlier slide, that net cash flow from investments on a per share basis increased by about 28% over 2022 compared to 2021, and that enabled our dividends to increase per share by about 16%. And of that cash flow from investments, we paid out 75% to shareholders. To assess the financial position of Sols, we don't really use the statutory balance sheet. Unfortunately, again, accounting standards confuse the situation. So many of our investments we might consolidate, we might use equity accounting. So we focus on what we call the NAV, the net asset value and net asset value per share. Because most of our portfolio is listed, we mark that to market, and the directors every 6 months look closely at the value of our unlisted portfolio and make an assessment of what we think is the fair value of that. So that removes any of the noise that might be introduced by the various accounting standards and gives everyone a clear and visible market value of what we think our portfolio is worth. And Brendan shortly will take us through the components of that and how that's changed over the last 12 months. So it is the clearest and most robust measure, and that's the anchor point that we use for assessing our performance as against the performance of the market. So hopefully I'm around. If anyone's got any questions and want to dive into the detail of the accounts, I'll be around afterwards, but I'm going to hand over Brendan now and take us through the portfolio. Thank you.
Thank you, David, and I'll be a little more detailed, so hopefully you can all stay with me. Hopefully I don't bore you too much, but I'll pop my glasses on here. But I'd like to start by saying how great it is to see a lot of shareholders here physically. I mean, there's a lot of familiar Milton faces here. Thank you for joining us. It's great to have everybody back again, and we're really excited to do this. And as the chairman pointed out, we'll be doing the same in Adelaide and Melbourne, and we're equally excited about that. Last year, we presented a plan to Milton and WHSP shareholders at the time of the merger. That plan involved combining two organisations to create greater scale, diversification and improved risk-adjusted returns, with the aim ultimately of delivering increased dividends for our shareholders. The plan also involved reducing the size of the combined listed portfolio to allow for investment in other asset classes and to improve overall financial flexibility. 12 months later, we have achieved both these objectives, as outlined by Todd and David. I'll be presenting the strong portfolio results and an update on our investments. On this slide, you can see the allocations to each asset class at year end. The total portfolio size is now $10 billion, growing by 72% over the 12 months. The strategic investments now represent 49% of the portfolio, courtesy of the Milton merger, which has reduced concentration. Large cap equities are now 31% of the overall portfolio, and we actively reduced this portfolio over the period and have continued to do so post-financial year end. On a net asset value per share basis, the asset backing has increased by 13.8% to 31 July and has outperformed the market materially. The working capital position has increased by $735 million over the 12 months through portfolio sales and cash generation. We have continued to take a conservative approach to the market, and have increased cash holdings, taking advantage of high equity valuations. We expect continued market volatility and slower economic growth as central banks increase interest rates to combat inflation. Our portfolios are well positioned to outperform in this environment due to our focus on defensive businesses with strong cash flows. I'll now briefly go through each of the portfolios in a little more detail. The strategic portfolio comprises large ownership stakes in publicly listed companies where we have board representation and a close alignment with management. Valued at $4.8 billion, or 48.6% of the total portfolio at 31 July, it generated $168.7 million in cash in the period. The merger with Milton has reduced the concentration of our strategic investments in the overall portfolio to 49%, from 72% in the prior period. 5 of these 7 companies have evolved from private equity investments, and the other 2, Brickworks and Apex, have been in the portfolio for several decades. During the year, we sold our stake in API to Wesfarmers in connection with its acquisition. We also merged our Round Oak investment with Aeris to create a larger scale player in Australian copper. We believe that our major investments are well positioned for future growth, but specifically in terms of our largest investments, we note the ongoing strength in coal prices, which has materially improved the New Hope share price and dividend income. At Brickworks, the repositioning of our property portfolio is highlighting to investors its embedded value. And at TPG, we expect an improved competitive position should the regional roaming announcement with Telstra be approved. The large cap portfolio grew significantly through the merger with Milton and is now worth approximately $3.1 billion, representing 31.2% of the overall portfolio. Substantial sales were made in the period, with the portfolio net selling $570 million since the merger with Milton in October. The portfolio remains actively managed, does not replicate any index, is income oriented, and takes a fundamental long-term approach to investing. Post-merger, we are able to more actively rebalance the portfolio without concerns related to tax slippage. We are also able to participate in liquidity events and take opportunities to extract greater income from the portfolio via the use of options. Notwithstanding the reduction in certain investments in 2022, the portfolio outperformed the ASX 200 accumulation index by 1.6% in what was a volatile period. Net cash flow from investments was $116.9 million, an increase of 316% year on year. The large cap portfolio has been rebalanced in the context of our broader asset mix, leaving the portfolio underweight resources, real estate and telecommunications due to offsetting overweight positions in the strategic portfolio. The portfolio is highly liquid and may provide a source of cash for new investments in other asset classes in future. We are taking a conservative approach to the equity markets at present due to interest rate concerns, and note that market valuations are in line with historic norms, but are not yet cheap. It has been an active year for the portfolio, both pre and post-merger. As we have rebalanced the portfolio, we have primarily focused on lightening our exposure to the retail banking sector. We anticipate a slowdown in credit growth and growing margin pressures due to wage inflation and competition, pressuring earnings for the big banks. We also note that credit provisioning is at historically low levels and could represent a drag on bank results should unemployment rise due to an economic slowdown. We have also reduced or exited investments in the property sector due to concerns over interest rates and property valuations. New investments have been made in the year in IDP Education, which is exposed to the international student market, Domino's, which is an investment in the growing market for fast food, Computershare, which has an earnings profile correlated to higher interest rates, and we've made additions to existing investments in JLG and car sales in relation to capital raises. 90.1% of the portfolio is now represented by the top 30 holdings. We have made concerted efforts in 2022 to concentrate the portfolio, noting that this will result in greater divergence of portfolio performance from public indices. At 31 July, we are underweight exposure to retail banks and materials, and overweight diversified financials, consumer staples and healthcare. This is a change from the former Milton portfolio, but we remain consistent in our focus on investing in companies that deliver us growing earnings and dividends over the long term, a strong management team that is shareholder friendly, businesses that are best in class providing pricing power in an inflationary environment, and exposure to positive long-term trends. In our private equity portfolio, we seek to invest in businesses looking for a capital partner to grow. We are aiming to patiently develop a portfolio of platform assets that we can grow with further investment over time. We have identified a number of themes that we have particular interest in, which include the energy transition, financial services, health and ageing, food and agriculture, and education. The current portfolio value is approximately $650 million. The portfolio has generated income of $40 million over 2022. During the year, Round Oak was merged with Aeris Resources to create a scale player in the Australian copper industry. This moved our investment from the private equity portfolio to the strategic portfolio. Our largest individual asset is a $175 million investment in AMP Control. WHSP now own 100% of the company after an increased investment during the year. Agricultural investments, including water, represent $240 million of the portfolio and remain an area of sustained focus for us. We continue to see a lot of activity and have a pipeline of interesting opportunities, which we will approach with our customary discipline. The emerging companies portfolio targets companies outside the ASX 100 that are exhibiting strong growth and are often positioned to benefit from technological or structural changes. The investment team have been active in public and pre-IPO placements. The portfolio value at 31 July 2022 was $612 million, and the portfolio outperformed the index by 7.5%, delivering a total return of negative 3.4%. The small cap market had a challenging 2022, as rising interest rates generally tend to impact higher growth companies. Cash flow from investments of $27.6 million was lower in the year due to reduced trading income. Whilst the investments in this portfolio can be volatile, we see the potential for outsized returns over time in these companies, and our long-term investment horizon is a competitive advantage for us. Another advantage is identifying emerging or disruptive forces in the market, or highlighting opportunities for the broader portfolio. A recent example is our debt investment in EOS, which started as a position in the emerging portfolio. Our structured yield portfolio comprises investments in quality companies through instruments that carry a high cash yield to maturity, are downside protected, and can often provide some equity-linked upside. Each asset is unique and may take the form of a simple loan all the way to a more structured instrument. The portfolio leverages our expertise across the capital structure and provides an alternative investment format when equity may not be optimal. We have developed strong connections in this part of the market and see a strong flow of opportunities. The structured yield market in Australia continues to grow, and we are looking for opportunities to collaborate globally. We have $250 million invested in the portfolio in 11 individual investments across a range of industries. The portfolio produced $19.7 million of cash in the period, up 18.7% on the prior period, and has a yield of approximately 9%. During the year, we moved the convertibles portfolio from structured yield to emerging equities, reflective of the dominant equity theme in those investments. We believe that this asset class will continue to provide the opportunity for strong risk-adjusted returns and plays to WHSP's strengths. Our direct property portfolio comprises 8 assets with a value of around $226 million. We have had strong revaluations in the portfolio, with the portfolio returning 47% over the 2022 financial year. During the year, we have acquired small industrial sites in Kirrawee and Narellan, and we remain opportunistic, looking for transactions that can generate outsized returns through development or repositioning. The property market has been very active with rates low and valuations high over recent years, reducing the number of well-priced opportunities. This has changed with the rapid increase in interest rates, which is expected to be felt in lower valuations in the future. This may provide future opportunities for WHSP. We expect rents to continue to grow, offsetting lower valuations. From a broader portfolio perspective, we are mindful of our look-through exposure to industrial property in brickworks. Also in the portfolio is our retirement development in partnership with Provectus in Cronulla. Our joint ventures in Ellenbrook and Huntlee have performed strongly with record sales at Huntlee over the 2022 financial year. We've worked hard over 2022 to ensure that WHSP has a strong balance sheet, financial flexibility and minimal debt. We have done so primarily by raising substantial amounts of cash. This solves for two key objectives. It allows us to respond to opportunities without the need to borrow or liquidate investments. It also reflects our cautious view on the investing environment at present. Post the Milton merger, we were able to complete these transactions in a tax-effective manner. At 31 July 2022, WHSP has a net working capital position of $274 million, bolstered by significant portfolio sales over the course of the year. The cost of our debt is low, aided by the convertible bond offering that we conducted at the start of 2021. We have access to further debt should we need it, but have always maintained conservatism when it comes to gearing levels. We have continued to raise cash via asset sales after financial year end. Our liquidity position ensures that we have the flexibility to invest and build a portfolio of productive long-term assets that generate strong returns for our shareholders. Thank you very much, and I'll now hand back to Todd.
Thanks, Brendan. I'll just try to summarise with a couple of slides on strategy and outlook, and picking up on a few of the themes that Brendan talked about. We positioned the portfolio, I think, very well for the current conditions. The hard work of the last 12 months puts us in a very favourable situation. Not only did we sort of get ahead of some of the recent selling in the equity markets by reducing our exposure to Australian equities, but we also have continued to increase our exposure to the structured credit. So $250 million at the end of 31 July, that's now $450 million. I think that is a very defensive way for us to invest. We're getting returns that are better than the long-term average returns from Australian equities without any of the volatility or downside risk, as an example. But looking at our major strategic investments, we've always had a bias to low-cost, high-quality businesses which generate strong cash flows. This adds resilience in more challenging markets. We're also attracted to robust businesses with defensible business models capable of passing on inflationary pressures. And the other aspect of our portfolio setting is, as Brendan mentioned, the increased liquidity to take advantage of opportunities. So that liquidity levels that he mentioned as at 31 July have actually increased over the course of the last couple of months. And that gives us the flexibility to take advantage of more structured solutions for growing companies who we're seeing a lot more and more having difficulty accessing equity and debt markets. And we can structure a variety of different ways to invest in those businesses to help them on their growth journey. And our experience is actually there's going to be a lot more of that coming. As I mentioned, the equity markets and debt markets are getting a lot more difficult for people to access. So that will create less competition and better deals for us. So finishing off, why invest in WHSP? We've got there the 4 Ds that we are disciplined long-term investors. We're very conservative and cost-conscious, which means that we invest in businesses that have a margin of safety against their competitors. If you're the lowest cost operator in a particular industry and things get tough, your competitors are going to have a lot more challenging time before you will, and that actually puts you in a position of strength and advantage. We deliver. We have a long history of outperformance, and we do that in a way that is lower volatility and lower risk. I hope I've been able to demonstrate that our dividend history is very stable and that consistent growth is very favourable. And our diversified portfolio actually provides a lot of security for us to be able to continue that. We're defensive. So we have a portfolio of uncorrelated investments that perform throughout the cycle, and our bias to resilient cash generating quality businesses should hold us in good stead. And if I wanted to add a fifth D, I'd say that we're discounted as well. And so at the moment, we're trading at a discount to NAV, and we hope that the market will acknowledge the long-term performance that we've had and give us the premium that we deserve. But just to finalise, there's some important dates there for shareholders over the next couple of months. We've got the final dividend ex-date, record date and payment date coming up. And then there's the AGM on Friday the 9th of December, and we hope as many of you can attend as possible. It'll be streamed as well, but we'd love to host you at the Wesley Centre on the 9th of December. So on that, I'll thank you for listening to all of that and open it up to Q&A. There'll be some microphones coming around, so just if you wouldn't mind sticking up your hand, we'll get a microphone to you. So we've got there's one at the front and one at the back as well. Thank you.
Before we take questions, I think one of the main reasons why we've been so successful over such a long period of time is we've always had good people. And I think you've just seen this morning the presentations from these young fellows I got on my right. We've never been able to send somebody out to a coal mine or one of our investments if something happens. So we've been very fortunate that we're able to pick very good people over a long period of time. Just before we go to Q&A, how many Milton shareholders were here before we did the takeover? Can you just put your hand up? Yeah, okay. Interesting. All right, on that note, we're happy to take some questions. The girls got the microphones. And just before we finish, I'd just like to thank the girls for putting this together. It's been quite an effort to do it, particularly organising here, Melbourne and Adelaide. So thanks, girls. Easy to sit down, I think.
Hi there. Thanks for setting up this company briefing, and nice to see you, Mr. Barlow and Mr. Millner. If I may, I'm going to ask you two questions, if it's all right with you. I love your investment strategy and your long-term conviction portfolio. Now, the first question is with regard to the AFR article that's dated on the 20th of October, 2022, about renewable energy, that you've been open to investing in that field. What do you see as opportunities and threats to your existing energy business? And the second question is basically based on your based on the slides there, Mr. Barlow, you're saying that WHSP is trading at a discount to NTA. Would you consider a buyback?
Sure, thanks for the questions. So I'll take the renewable energy part first. Would we be open to investing in renewable energy? Absolutely, and there's plenty of ways to play that. We think that the investment that the world will undertake in renewable energy will be significant in the next few decades. Will that be a threat to coal? Eventually. But for the moment, we feel very good about our coal investment. We had this question around whether coal had a future a couple of years ago when it was trading at about $50 US. It's now above 350 US, and so our thesis that the world would need some thermal coal energy whilst we undertake this transition was absolutely correct, and we're making a very significant amount of money out of that asset at the moment. But we recognise it's not going to go on forever, but is it a sustainable investment? Well, maybe it won't be around in 50 years' time, but it's certainly a very valuable asset for the time being, and there will be a transition that will take place. So how do we get involved in that transition? How do we benefit from that? We don't necessarily think that we are the best capital to invest directly into renewable energy projects. There's lots of capital looking for that. It's infrastructure-like, it's low returns, it takes development risk, it's got technology risk, and you need to be a specialist at it. So it's not really the way that we want to invest in that sector, but what that sector that transition will need is, is a very significant investment in engineering capability, know-how, people power, and so that's the thinking behind our latest private equity investment in Amp Control. We think that a picks and shovels approach to this significant investment in not just renewable energy, but the renewal of the grid to be able to cope with that renewable energy. There'll be some very significant investment in that space, and we need engineers, manufacturing capability to be able to execute on that. So we are invested in the theme already. The other way to invest in the theme is through the commodities that will be required. So if you think about the amount of steel in wind, the amount of copper in the new grids and renewable energy and electric vehicles as an example, we're very, very positive on the outlook for copper and the demand that's going to be required versus the supply that copper has in the world. So there's lots of ways to play it. We don't have to directly go into renewable energy projects, but we do believe that there will be a transition and lots of investment and lots of opportunity. On the issue of buyback, I mean, we are trading at a slight discount. It's something that we would look at if it persisted, but that's partly the rationale for having these kind of days, so that we can communicate with shareholders that the share price is a little low relative to asset value. We'd like to be able to correct that through information, but if it persists, then that's something that we could look at.
Just on that, obviously New Hope was very close to doing something before last Tuesday night, and that's had a kibosh put on it, and the off-market buyback. And just on the renewables, I don't know whether some of you saw there was an article in the Fin Review last week. New Hope owns well over 20,000 acres of its own land at Ackland, where we're still waiting to get the final approval. We are talking to the Queensland government there. We are the most advanced as far as rehab goes. So we are talking to the Queensland government whether there is something we could do there on the renewable fronts, either solar or wind. And also we have a vast amount of water which we receive from the Toowoomba Council. So we are involved in some type of renewable projects already through New Hope.
Good morning. Reece, you just touched on EOS before. I'd just be interested to, I noticed it was very favourable terms for Sol when you did that transaction. Just interested in your thoughts on that and the long-term implications of getting into EOS. Thank you.
Yeah, we've been invested in EOS for a number of years now. We quite like the intellectual property. I think if you're not making money in defence services right now, then you're not doing a very good job of it. And so it's a fundamentally good company, but it got itself into cash flow problems. And we were a reasonable sized shareholder. We owned about 5 to 6% of the stock. They came to us and asked for effectively emergency capital. It was a relatively high risk time for them, because if they didn't source the capital, it would have been very challenging for them. But we were very happy to be able to provide them with the lifeline to survive and thrive. And so they're now in a position where we put $70 million of capital to work to give them more time to be able to execute on their strategy. And we think the future is quite bright for them, because they are very good assets. They've done a lot of hard work, but they probably invested too much in R&D. They invested too much in increasing their balance sheet with a lot of work in progress and inventory, and that just needs some time to sort itself out. But we were very proud to be able to step in and provide a solution in a very short time.
I've just got a microphone here. If we can just go this.
Thank you for the clear explanation. I wonder if the discount on the share price relates to what I've always understood is lack of major institutional interest in the stock, or whether it's covered or not. Because when you look at anecdotally the results, the New Hope coal, whilst renewables going to come in, it's going to be in a very haphazard way. You can see the Fortescue example. It'll be different for each company. And I think the world's focused on turning the switch off, but I don't know if there's the reliable substitute there. So is that a fact do you have any further ideas on why it's trading at a discount? Because it doesn't seem to make sense.
I think it was just a short-term thing. If we look at the average over the last 3 years, I think it's about 12% premium. So the last year has been an aberration. And I think what happened was we had 30,000 shareholders from Sols, 30,000 Milton shareholders, and when we put them together, we only ended up with 55,000 shareholders. So a lot of Milton shareholders perhaps said, well, I'm an LIC investor, I don't want to be here, or they took the, and we offered them a nice premium, and the share price ran up, and there was a good opportunity for them to exit. So I think a lot of people kind of sold in the first year, but then what we saw was we got down to 55,000 shareholders, and then it started reversing, and now we're up to 60,000 shareholders again. So we've attracted another 5,000 new shareholders in the last 6 months or so. So people are starting to understand the strategy again and buying back into the stock, which is great. So I think it is a short-term feature that we are trading at a discount. I expect that to close over time. And on the issue of institutions, we do struggle to get institutional interest in our stock because we are an investment company. The professional fund manager investors, kind of look at us and say, well, you do what we do, and they might not necessarily be able to convince themselves that we do a better job of investing than they do. So they're reluctant to invest. But we do have about 20% of the register is institutional through the passive index fund. So just by virtue of our size, we have nearly 20% institutional interest. It just has to be there, and they're never going to go. And so long as we are in the index, they'll stick around. And that's kind of perfect for us. We don't want people to come in and be short-term and drive us into short-term decisions. We like the fact that we have mums and dads who have owned our stock for a very long time, come on the journey with us, enjoy those kinds of returns that we've delivered over the long term. And so we think that over time it'll sort itself out, and we very much like having retail shareholders and passive institutions because it takes away that pressure that a lot of other companies have to deliver short-term results.
Todd, you talk about the moderate discount Sols is trading at, but Brickworks is trading at a significant discount. Are you able to comment on the strategies that Brickworks may look to implement to try and close that discount? Because I think the NTA might be sort of $30 odd and it's trading at $21.50, $22.
Well, I can't really comment exactly on what Brickworks is doing. It's a question better for them. But we have engaged with them because we've been on that journey before. If I go back to a decade ago, Sols was trading at quite a significant discount as well. And the way that we closed that discount was basically giving people the information. We gave people what the net asset value was. We steered them away from the balance sheet, which was very confusing, as David mentioned, and basically said, here's what the value of the portfolio looks like. And then we kept generating returns and we kept paying dividends, and that was very helpful. So Brickworks is sort of engaging with us to learn about our experience there and how they might be able to close the gap, and hopefully they will over time.
Todd, just with talk increasing about the need for countries to potentially pay for their energy with their own currency rather than USD, how do you see that? How do you see New Hope responding to that? And if that would, presumably because the US dollar would take a big hit under that scenario, how do you see New Hope responding to that, please?
It's an interesting question. The reality is, we don't sell into the US and we don't really sell much into the Australian market. So if that scenario played out, we would be exposed to the currencies of Japan, Taiwan, and various other Asian economies. It just so happens that the US dollar is the established kind of currency for trade, and it's been that way for a very long time. It's unlikely to change, in my opinion, in the future. But if it did happen, I think you would end up looking at a basket of Asian currencies and particularly something like the yen, which is, you know, a very significant currency, I don't know that it would be a huge risk for New Hope.
We've got some questions down here. Can we?
In the front.
One question and two compliments, maybe. You haven't mentioned your MER, which I think is, before I withdraw the compliment, you might tell us what it is. Secondly, your share price, the shares are still cum div until the middle of November, so there's a 58-cent dividend there for anyone who wants to buy at a discount and pick that up as well. So there's two compliments, and may I say, I appreciate greatly, and I'm sure we do, the presentations today so far. Rob, you just in your comment said about New Hope and the Ackland, you just said still to be approved or something like that. I know you've been wrestling the Queensland Government for ages. The water licence has been approved. Are there any other approvals that we're still waiting for?
The Premier of Queensland announced in Parliament that she would approve the project when all approvals had been given. We received the final approval 2 weeks ago tomorrow, I think. We still have not heard from her about starting our engines and getting moving. Management, who obviously are based in Queensland, are very confident that we will get a tick. We've kept all our machinery, so we could start our engines tomorrow and start moving topsoil to start producing some coal. So it's been very frustrating. 14 years we've been fiddling around. We're going to be very kind here, with various organisations. There's been coal mining in the area for 100 years, and we're hoping that within 3 months we'll be scratching the surface of the earth.
And just on your question around MER, thanks for bringing it up. It's a good point. We don't disclose it, but that's not because we're trying to hide it. In fact, it should be something that we should be putting up in lights, because it's about 25 basis points, or, you know, 1/4%. And the reason why we don't talk about things like that, and, you know, another reason why we don't publish our monthly NTAs is we don't want to look like an LIC. We think that we are a different investment product to an LIC, and we act very differently. And if you think about the LICs, they are very low MER, and I think our 25 basis points would compare very favourably to LICs, but you won't get LICs who have done $7 billion of activity in the last 12 months. And so we do a lot more active trading of our portfolio. We're invested in a lot more diverse assets than a normal LIC, and yet you're getting all of that for the same cost as what a typical LIC would charge, or, well, not charge, but, you know, embedded in their management expense ratio. And so, you know, another way that we'd like to demonstrate to the market about the value that we bring is, you know, it's a $10 billion portfolio. Now, if somebody had an external management company overlaid onto that $10 billion portfolio, and you were getting the kinds of performance that we are delivering, and you're getting the kinds of asset classes that we're bringing, you know, I would think that the total cost of that service would be between 1% and 2%. And that's between $100 and $200 million of management fees that are captured within the company. And that's a very important point that we'd like to demonstrate to people, you know, in the future. And I'm trying to think about how we do that, but that's value that is captured by shareholders. No performance fees, no external management fees. That's right. Julianne, could we get a mic down here?
You put his hand up first.
Yeah.
It's the first one.
Sorry, I think part of my question's been answered about 3 times, but I'm also onto this discount. First of all, I congratulate you on your presentations today, because I'm sure that's a great assistance for all people, because sometimes I've found it's been a little opaque. You did mention that the discount as at the end of July, which is the end of the financial year, was about 7%. That was 3 months ago. We got any idea what the discount is as 3 months later, which is as of the 31st of October? And I do appreciate your comments about not presenting that with great frequency like an LIC, but it still seems to me as though it's a pretty useful piece of information for we shareholders. I notice that your associate BKI do it every week. I know it's a different business, but they do it, and they also show the actual share price, which I find quite useful. I must say the broker that I deal with has always been slightly confused about the whole thing, and I couldn't understand why such a large discount applied some time ago, but I wasn't too sure that it was a real discount in any case because I wasn't getting much information. So I'm wondering if you can tell me what I should preface, it's not that easy for you to determine the NTA because you've probably got a lot of unlisted things and some of them are estimates, so I can only assume you could produce an estimated NTA.
Yeah,
and,
so
and the relative discount.
At the end of September, the discount's, it's like 3.7%.
3.7?
Yeah.
Right, okay. Well, in any case, it just seemed to me as though that could be publicised, perhaps maybe monthly or something like that. It's very useful information.
Yeah, we try to get it out as often as we can. I mean, we do it at the half and the full year and talk about it at the AGM. But
So you're buying something undervalued. Exactly. I can never work out, I'm not going to name it, but some of the leading investment companies are trading at a 12% premium. Why would you want to pay 12% more for something that's worth? I can never work that out. I think if you can trade at 1 or 2% under your people are getting good value.
Yeah, thank you.
As a buyer. Obviously, if you're a seller, you want to be higher than that.
Julian is.
Good morning and thank you for having us. Can you comment a little bit about how you allocate amongst the high-level portfolio sectors? Is it actually an overweight, underweight on specific weighting, or do opportunities just find their way? Is it a more bottom-up and they find their way into a category? When you go into fixed income as opposed to strategic, so a bit more top-down commentary would be helpful. Thank you.
Yeah, I think it's very much the latter. We approach our view around investing through the lens of the investment itself. So when you look at the portfolio as a whole, we're certainly not trying to hit an allocation per asset class. And it is very much the case that we've been taking money out of listed equities and moving it around into other parts of the portfolio, but we're not really trying to hit a number there at all. And I think that's exactly how we want to continue to operate. I think indeed one of the real advantages of bringing these organisations together and putting us in our place where we can move the portfolio without tax slippage is it allows us to do just that. So if we find an excellent opportunity in structured credit and we want to deploy $500 million to do that, we can look at that through the lens of a comparable opportunity in the listed portfolio. And if we think that's a better risk-adjusted return, or we like the look of that in terms of the environment we're in, then we should be willing and able to do that. And that's exactly how we're positioned right now. So. Correct. So we don't have a situation where we have portfolio managers competing for capital. We're very much looking at every individual opportunity individually. And what drops out is the allocation that we have.
I think it's a really important distinction. I mean, most other investors or investment teams will have some ownership over their portfolio and they'll fight to keep their funds invested in their particular portfolios. Whereas our investment team sits across the entire portfolio, and that means that not only is the allocation more dynamic, but it also makes them better investors because investing is a relative game. How do I know that X is a good investment if I don't know what Y can do? And so we have the ability for everybody to look at all of the investments that come through the door and work out what is a superior risk-adjusted return. So a good example recently is we trimmed our bank exposure because we were investing in some bank bonds that were paying us 8 to 10%. It's pretty obvious to anyone in our team, at least, that I'd rather get the downside protection from a bank bond than the equity risk that I'm taking on banks right now and getting a 5% dividend. So it was just an easy decision.
Any more questions?
Another one down the back there.
Right up there.
Sorry about this. Just to capture your comment there, Mr. Bala, in regards to bank bonds and bank dividends. What about what about the consideration of capital appreciation with those bank stocks or the potential of it?
Yeah, absolutely. I mean, you've got to take a view on whether you think that that's an opportunity or a risk. And we look at the banks right now and think that equity, those sorts of equity prices are more at risk than they are an opportunity. And that's our view. But I think that, you know, as I said, the long-term returns of the equity markets on a total return basis have been about 9%. And we've had some pretty good years in the last couple of decades. So, you know, our house view is that there's probably some leaner times ahead, but if you can get something better than 9% and not take any of the equity risk, then that's going to get you a better risk-adjusted return long term.
All right, well, thanks everybody. I'm sure you'll find the morning tea acceptable. So we'll be here for a while to have a chat with you. So please feel free to go and have some morning tea and we'll catch you.